Our guest this week is Rajiv Bala, co-founder of Clutch VC. Clutch is an Austin-based firm that makes seed investments in B2B software. We talked about the importance of staying true to your investment thesis, the strategy that enabled Clutch to raise a strong first fund despite a terrible environment, and whether it's true that you have to be in a billion-dollar deal to produce a great venture fund. Please enjoy. Rajiv, thanks for coming on to talk today.
Glad to be here. It's going to be fun.
So, fun fact, after I moved to Austin 2 years ago, I'd get in conversations with people, other early stage investors, and talk about what I was looking to do. And the first thing people say when you move to Austin and you're involved in startups is, oh, you should check out Capital Factory, which great, sure. But then have like a little deeper of conversation. And they would like kind of pause for a second and they'd rub their chin. They'd be like, has anyone introduced you to Rajiv Bala? And this must have happened to me 15 times. I'm not exaggerating the number of times it happened. And it's funny because we did meet very early after I got here through a mutual friend, Toby Shute. But yeah, over and over, I've had more referrals to talk to you than all other investors in Austin combined. So
that's good. We need to do more deals together.
We should. But yeah, just seemed like a great excuse to have you on the show and talk shop. So thank you.
Awesome.
Maybe to get rolling, can you talk about how you ended up in venture in the first place?
Yeah. So I'm a native Texan, grew up in Houston, went to Rice where I met our mutual friend. Was an electrical engineer for a few years, and then a marketer for a few years, all at Texas Instruments. And then decided to come to business school at University of Texas because they have a program where you can intern at venture funds. And I figured, hey, let me go get some exposure to that, and then I'll go be a product guy at a startup. But I ended up through the internship program meeting the founder of my old firm, S3 Ventures, and joined there as an intern first, and then came on board as the first full-time employee. And that's, as they say, is history. I was there for about 10 years and then left there to start Clutch, and been doing this now for about 4 or 5 years.
I had a funny chat where you came up where I was talking to Jim Nolan at UT, who, for people would know, he organizes what is a very popular like internship fellowship program out of UT. And you came up because he was like, have you met Rajiv? And I'm like, I have met Rajiv. And he after he was like, he went through the program and he did one of these fellowships. And at the time, it seemed like he was working more on the fellowship and the internship than he was at school. And I was like, Rajiv, are you sure you spent enough time on school? And he was like, no, I know, I definitely want to do this. I'm focusing. I will say it seems like it worked out pretty well as far as putting you on the track you wanted to be on. But
it was the right place, the right time. Austin at the time was not what it is today. There was certainly a tech ecosystem, but this was 2008, and you may remember that Twitter launched at South by in 2007, and that's really what put South by on the map for a lot of people around the country. And so very, very early, the iPhone hadn't really come out. It was a very different world back then, but since then, Austin's just been up and to the right. So happened to be at the right place at the right time.
So you left S3, which I would say S3 is not like a nationally known firm because they tend to focus on Texas, but within Austin and within Texas, great reputation, super thoughtful. What inspired you to leave a place where, really stable shop, great people there, to go out and start your own thing or to co-found something new?
Yeah, it really comes down to the market opportunity. So the Austin's still a pretty small market, but back in the early 2000s, there was one dominant firm, Austin Ventures. They raised a pretty large fund in the early 2000s, and they drifted later stage, and that's why we started at S3, Silverton, Live Oak, Next Coast, Mercury, Eddy, Houston. We all started with smaller funds after Austin Ventures moved later stage, and we're kind of filling in this gap at the earliest stages. And um, then we all had success and raised bigger and bigger funds. And my kind of core thesis was that as these funds got bigger, someone was going to have to come in and fill the gap at what is now called pre-seed, basically post-product, early revenue, pre-revenue investing. And that's the stuff that I really enjoyed, being a product guy by background. I really like that messy product iteration, team building phase of the business. And so the market opportunity combined with kind of what I'm passionate about just happened to line up. And I thought it was a good time to go start hopefully the next generation venture firm in Austin.
I agree. So let's talk more about your firm. Can you tell us more like what Clutch is about?
Yeah, so we invest in pre-seed and seed rounds for B2B software companies in Austin. So, or sorry, in Texas. We our typical check is $500,000 into $1 million to $2 million round. We're happy to lead, happy to syndicate. We will go as early as 250K into really a pre-product company. If it's a team that we worked with or that we know really well, we'll go as late as $1 million into a $3 to $5 million seed round. But really where we're focusing at the moment is same area that you're focusing in, which is where there's a lack of capital. And so we think we can have an impact on the ecosystem by focusing on pre-seed, anything 0 to $1 million of ARR in revenue. We are mostly SaaS investors, but we'll also do marketplaces, consumption models, as long as it's B2B software.
I saw on your site you make it a point to say that Clutch does safes and priced rounds, and I know some investors are very fussy about price rounds. Curious how you think about those different options on the menu and in different situations.
Yeah, to us, it really comes down to cost. How much cash do you want going out day one to get the round done? If you're raising $1 million, a price round these days is going to end up costing you 50, 60K to paper. So do you want to spend?
For listeners who aren't as familiar, these are legal bills borne by the startup.
Correct. And so do you want, and the startups pay for investor counsel financing as well. So it's usually, call it 20 to 30K on both sides of the transaction to get a priced round done. And so do you really want that money going out the door day one? In a sub $2 million round, the way that we think about it is no, we don't want that cash going out the door. In a over $2 million round, it's better for everybody to just do a price round. That's not hard and fast, but that's kind of our rule of thumb.
I met a GP in town who I'm not going to name, but they're a couple funds into their journey. Things have gone well. And they were telling me about the deal that made their firm. And this is a seed fund. And their first deal was the Series D for Zoom, which turned out to be a pretty big win. And it's funny because I came home and I was telling my wife about it. And I'm like, I'm not sure how I feel about that. On the one hand, it was a smash success. On the other hand, doing a Series D check doesn't feel super on thesis for your first check out of your first one with that strategy. How would you think about something like that?
We wouldn't do it in our fund. If we really believed in it and we thought that it was an amazing opportunity and we were willing to go off thesis, we might take it to our LP base and say, hey, we think this is a really great deal. Do you want to do it? But we have a fundamental thesis around if we are trying to 5x plus our pre-seed fund, and if you and it's really hard to underwrite Series A deals to returning the type of multiples that you need. You basically need a 50xer if you follow power law distribution return outcomes. And it's hard to underwrite a Series A to a 50x return. And so even in our follow-on deals, Series A plus, uh, even if we have capacity in the fund, we will usually spin up a sidecar vehicle in order to do our pro rata into those Series A, B, C rounds.
Why focus just on Texas? I like the place. It's great.
Yeah.
But I'd love to hear more about the focus.
Yeah, so our style of venture capital is very hands-on, and so we believe that you need to be physically close to your companies in order to be able to really affect change and be helpful in your portfolio companies in the way that we want to. So, we've got portfolio companies in Austin, Dallas today, and in the past, I've had Houston, San Antonio, others. But when a founder calls us up and says, "Hey, I've got this problem," if we can drive down to them and start whiteboarding out a solution, that is where we feel like we can add a ton of value. Secondarily, all these companies at this stage they need to hire executives, they need to hire middle management. And my partner and I have just been in the business or the venture capital business in Texas for so long that we have very deep networks in order to bring the right person into the right business at the right time, which is one of the highest leverage things that we believe you can do as a venture investor or board member. So in our style of venture, being close really, I think, matters. I also think this is the most inefficient part of the market. Most of these pre-seed deals are non-consensus deals. You've got to get conviction, help build the syndicate because they're all club rounds. Pull a lot of people together. And that makes the market very inefficient. And that's where we believe as an investor, you can have a lot of edge.
I get the comment occasionally, because I also like B2B SaaS, that it's picked over and people view it as well understood by the market and making it harder for people to find, call it mispriced situations. How do you think about that?
I think that has become more and more true as companies mature. So, when you've got a 15, 20, $50 million company, everyone has near perfect information. And it is harder to have an edge, in my opinion, or at least with our strategy. I think the earlier stage you go, there is less information. There's less financial information in particular to diligence. And so, it is a lot harder to have a saturated market in the earliest stages. That dynamic you're talking about, though, makes it great for an early stage investor. The fact that there's a ton of capital at the later stages for SaaS businesses, which is one of the other reasons that we focus on B2B SaaS, is the path to raising more capital, to exits, to intermediate liquidity in Series C, Series D rounds, private equity. It's now a well-worn path. And so you can, with certainty, understand if your entry point is, zero to a few $100,000 of ARR. You usually know if you get a company to 5, 10, 15 plus million of revenue that you can monetize that position. Maybe not at a great price, but you'll be able to monetize it.
Yeah. It feels like there's always going to be a buyer for someone at those kind of scale with, you're talking 90% logo retention.
Yep.
That's a great asset. It's a great business.
Yeah.
Somebody's going to want to own it.
Absolutely.
Maybe it's a question of price, but someone will want to own it.
Exactly.
How do you think about, and I'm sure you have maybe already been exhausted through these conversations about AI, but from your LPs, but how are you thinking about AI-centric business models right now and how they might fit with B2B SaaS?
Yeah, one of our most successful companies is a voice AI for food ordering company, and so they utilize all this AI technology. So, one, we don't do horizontal AI technologies. We're really looking for enterprise applications of generative AI and some of these other technologies. But what we're finding is that a lot, in order to create a business outcome with these AI technologies, you really have to have a lot of human augmentation, especially in the early days. And we're coming to the conclusion or the thesis that this is a continuous improvement problem, right? You're going to always be fine tuning these models for the specific application. It's never going to be done. And so, one of the things that we're toying with right now is, do these companies all have to maybe understand call centers or understand BPO? Are these consumption model pricing structures versus pure SaaS structures? How do the gross margins ultimately, in the fullness of time, end up? Because we don't think they're going to be full software margins if you ultimately have human augmentation at some point. So we're thinking through that. I don't think we have any conclusions at the moment, but we don't think these businesses are going to operate like SaaS businesses, and we're being very careful about how we enter and help these companies scale.
Do you only do vertical just across the board, or is it just specific to when you're looking at AI-centric deals that you're focused on vertical applications versus horizontal?
At this moment in time, with AI deals, we're only looking at vertical. We will look at horizontal in general. Oftentimes, though, we tend to be focused on capital efficient businesses, and so if it's a horizontal business out of the gate, oftentimes you want to try to find a niche to go dominate, and then expand to the next one and the next one. But because of the capital efficiency and because we don't have a massive fund, we are focused on more vertical applications.
Probably seen some of the same headlines I have about seed valuations staying fairly firm. And I'm curious how that lines up with what you're seeing on the ground.
Yeah, I would say that seed valuations, and this is where the nomenclature I think gets a little fuzzy.
Mm,
Seed, meaning $3 to $5 million rounds, haven't really budged from what we're seeing. Outside of the craziness going away. At pre-seed, we've seen them come down a little bit, not a ton, but what we have seen is we are not forced into making decisions in a week or two anymore. We are able to take our time, do real diligence. These companies, there's not a lot to go diligence, so you're really diligencing the team in the market, and our average time across the 16 years that I've been in venture and the 30 years my partner's been in venture, our average time from a first meeting to a close is about 6 months, and we'll go a lot quicker than that. The longest one I've tracked is 4 years before I did it. So we
I didn't
take our
know that's longer than I knew my wife before we got married.
yeah, same. But and to be fair, that was a later stage deal. But
The marriage or the deal?
the deal.
Okay.
But we and that's never been the type of shop that we are to make a decision in one meeting. And so uh, what we're seeing is the market is back to, it takes several weeks, 2 to 4 months to get to know a team and to get conviction around them and the market and the idea, and to close the deal.
How do you handle situations with a founder where you love what they're building, or maybe you're a big fan of them? Let's call this pre-seed, but they have unrealistic expectations around price, which I can see sometimes where you'll have someone who is true pre-seed as far as traction stage, but they're looking at seed valuations and they're like, "That's me, and I can raise it that." How do you have those conversations, or where in the process do you approach having that conversation?
If valuation comes up early, we will often react to it in that meeting. Um, if a founder is expecting to raise at a valuation that's ultimately out of our range or something we wouldn't be able to get to, we often just say, look, it'd be a waste of our time and a waste of your time to spend a bunch of time together to figure out if this is a fit, if that's the valuation that you're looking for, and we'll never be able to get there. What we often say in those meetings is like, hey, here, let me give you an idea of the other deals that I'm looking at and where they are in revenue and traction and history and where they're getting priced at. And so I kind of turn it around on them and say, if you were in my shoes, would you spend time investing in a company where the valuation to revenue is out of whack, or would you do a more market deal? And most times people don't agree with it, but they understand.
They say, "Oh, the out of whack one."
Yeah, exactly. But we often say, like, look, go, if you can get that deal, go get it. And if you can't, and you want a partner like us, then come back.
Yeah, I think it's fair. That's totally fair. I think it's fair on both sides. If they can, good on them. We haven't really talked about portfolio construction, talked a lot about kind of the picking side, but how do you think about piecing together the portfolio?
Yeah, I'm becoming more and more convinced at pre-seed that you make your money on the portfolio construction. You have to build a broad enough portfolio to where you're able to catch luck. You can execute flawlessly at companies at this stage, and if you don't hit the right tailwinds in the market or macro conditions, you may never have an outsized outcome. So you need to build a broad enough portfolio, and then reserve capital for follow-ons. And so the way that we think about it, we'll do about 25 or so companies in this fund, and we typically reserve about 1-to-1 for follow-ons. We've carved out about 10% of the fund to do inception stage deals, so very, very early. But with our core check of $500,000 and reserving 1-to-1, we think that a 25 or so company portfolio can give us enough shots on goal to where we can hit one or a couple, but where our check is meaningful enough that we can get ownership for it to move the needle on an outcome.
What is a conventional viewpoint in venture that you think is bullshit?
I was thinking about this one, and I think for us, it's that you have to be in the billion-dollar deals in order to produce a great venture fund. We believe that if you keep your fund size small enough and you are disciplined on the type of deal that you're doing and your entry price, you can create incredible returns, on couple hundred $1 million, sub-billion-dollar exits. And we've seen that happen in Texas for the past 20 years. We do have the billion-dollar exits, but some great funds have amazing performance without ever seeing an exit over $1 billion.
Well, I think it's a great point. I think it always kind of obscures. You don't talk about valuation. You're not talking about IRR. It's always through the framework of total cash payback, and I don't know. It depends on your your LP base. But I think IRR matters. Sounds like you do too.
Yeah.
Bit of a different topic, but you're on the board at Div Inc., which I think is a great organization. I'd love it if you could tell folks about that and what inspired you to get involved.
Yeah. So I recently joined in October of last year, though I've been involved with the organization for more than a decade. It's a great organization that supports underrepresented founders. There's the way that I talk to people about it is if you or I started a company and wanted to raise that friends and family round, we could go circle up 50, 100, 200K probably fairly easily. But if you are part of one of these underrepresented groups, overlooked groups, you may not be able to do that. And I think it's incumbent on us as investors to help lift those up. It just so happens that there's a lot of research that also says that diverse viewpoints, diverse founding teams create much better outcomes as well. So I think it aligns pretty well with what we're doing at Clutch as well. So it's a great organization. I'm really happy to be involved, and it's a really cool time to be involved over there as well.
Awesome. Maybe just to wrap things up, anybody, so let's say there's a founder listening and they're like, Clutch sounds like a potentially really good partner for me. What's the best way for them to get in touch with you?
Hit me up on LinkedIn, shoot me an email, rajiv@clutch.vc. Should be pretty easy to get in touch with me. If not, flag me down while I'm walking out of our office or something.
Awesome. All right. Well, this is really fun, Rajiv. It's great. Great we got to do this. Thanks for taking time.
All right. Have a good one.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.